Hello, and welcome to Capital Insight Partners 2021 Economic and Market Outlook. My name is Steve Nelson. I have the great privilege of leading this wonderful investment team as the CEO. So here in this module, we're going to talk about 2021 and what we see coming for the economy and the markets. I have good news to share. So if you look at this chart in front of you, what you see is we believe the economic recovery out of coronavirus will continue. There are several reasons why the economy should continue to grow. One, we still have monetary support. We still have fiscal support from Congress and the White House. We expect actually more of that after the election. And we also have good news on the vaccine front. So no matter how you look at it, we expect this to be a positive year for the economy. At the same time, however, we do not see interest rates or inflation getting away from us. The 10-year Treasury note will probably stay plus or minus 1%. It will be sort of range bound. So there is some inflationary pressure coming as the economy rebuilds, but we really do not expect it to get away from us in a meaningful way at all. So what we do every year for our clients and investors is we give you our base case. Our base case is what we believe is the most likely outcome for the markets. And we always look at a 60%, 40%, 60% stock, 40% bond balanced account. And when you look at what the stocks are expected to return, high single digits, maybe low double digits, and you look at what we expect out of bonds this year and you put them together in that 60-40 mix, we expect that most balanced investors should probably end the year around 6%. Now, of course, we may or may not be right on that prediction, but this is our base case. It kind of, as an investment team, is the most likely outcome that we have come up with. Now, we have a more optimistic case that we've looked at. We have a more pessimistic case. But again, for a balanced investor, we believe at the end of 2021, you'll probably be looking at a mid to high single digits kind of return. One of the things that's going to happen, though, within the market itself, there are a lot of dynamics below the headline number. And one of the dynamics that happens in the business cycle is that different industries perform better. So you'll see consumer financials or consumer discretionaries and financials listed here. You'll see industrials. Of course, last year, the market was strong, and for most of the year, it was led by a very few technology stocks. They really carried the market indexes higher. The good news for all of us as investors is right at year end, the market began to broaden out. So different sectors like financials, industrials began to start performing. Another way to think of this is that we started shifting from just growth stocks performing to now value stocks also benefiting, and the growth stocks on a relative basis backing off just a little bit. So this is a sign also that the economy should continue its recovery. When you see value stocks performing a little better, you really need the economy to do fairly well for that to happen. So we see this uptrend continuing into 2021. I don't know if you saw the footnote on the last page, but in our base case, we did make the point that following 2021, as we get to 2022 and beyond, things may slow down a little bit as far as our return expectations. But for 2021, good news, we believe the market will still be higher. So one of the things that's really fun to do is to look back in history. And we love looking at this chart. It's a 50-year chart. It goes back to 1970. And what you're looking at is in red the bonds, the interest rates on bonds, and in black you're looking at the stocks. And so what you see is that we have been in a 40-year bull market for bonds. What do I mean by that? As the interest rates have been coming down for the last 40 years, bond prices have been going up. The issue, though, is now we expect that to begin slowly, but nonetheless, we expect that trend to reverse and begin to go the other way. And that will be to the detriment of bonds. Conversely, stocks we know are at all-time highs in the market, and they are not cheap. They are expensive. But if you ask our investment team, we have, of course, we discuss this all the time, we've come to the conclusion that, frankly, the bond market is a little bit more risky than the stock market, particularly given these low interest rates for the period of calendar year 2021. Another way to look at the market is what is the mix of monetary conditions and fiscal support, and the folks at BCA had done some work on this, and the simple message is, like we saw in 2008, the great financial crisis of 2008 coming out of that into 2009, the conditions right now are supportive for the equity market, the stock market, to continue to perform well. The numbers are a little different. Back then, stocks were not as expensive as they are now, but interest rates were a lot higher than they are now. But if you just look at these two circles, what you'll see is that conditions today, like they were in 2008, 2009, are conducive for the market continuing to move higher. So again, we favor stocks in 2021, and we believe it will be an okay year. Of course, as we make this prediction, we have to keep in mind that we could be wrong. There are many ways that we could get that prediction wrong, and there is always risk when you invest. One of the things that we'd like to invite you to do, because this is a fairly brief look at 2021, is to pick up the phone and call, or to send us an email. If you have further questions, you would like to explore these topics in greater detail, please feel free to reach out to me or anyone on our team. In addition, you can always visit our website. And we really thank you for participating in our 2021 Economic and Market Outlook.